A theme throughout the semester has been what will happen to the equity if assets drop in value more than the value of liabilities. If a bank doesn't have enough equity, then a drop in the value of the assets means all of these liability holders won't get paid. Now, in Chapter 20, we're concerned with bank capital, and you could think broadly as bank capital being the equity of the bank. Maybe more specifically, the investor supplied capital, not deposits. So these are the parties that finance the bank who might not get paid back. And you need to have enough of that capital so that the depositors will be able to withdraw their money when they want it. Or there's several reasons why you need to have capital. So the first is unanticipated losses might remove confidence in a financial institution. And so if you have enough capital, that can absorb that loss. And so other banks would be willing to continue to lend to that bank, for example. It does protect the other liability holders besides the depositors as well. So it increases confidence all around. There's enough equity. It protects the insurance fund of the financial institution. So for banks, this is the FDIC. And it protects the financial institution owners against insurance premiums. So the Federal Deposit Insurance Corporation levies a premium on banks for its insurance of deposits. If a bank has a low level of capital, it will be more likely to make a claim against the FDIC, and the FDIC will pass that cost back onto the bank in the form of premiums. So if the bank can have more capital, then they can save on the premiums they have to pay. And the fifth function of bank capital is it finances the real investments necessary to provide financial services. Up to this point, we've talked about the bank collecting deposits and then loaning them out. Well, in none of that discussion did we consider the fact that the bank has to pay for its building, and that would be an example of a real investment. Something has to finance that. Now, the book spends a lot of time differentiating market value from book value, and it really comes on the side of bank capital is best measured with market value. And market value is the assets minus the market value of the assets minus the liabilities, and that is also called net worth of the bank. And that in finance is always what we do care most about, is the market values. However, it's difficult to measure market value. Therefore, regulators are often using book value, and they implement formulas to try to approximate what the market value is of the bank capital. Now, one name you need to be familiar with as we talk about capital adequacy is called Basel. Right? So the Basel rounds of the Bank for International Settlements. Right? So this is part of the Bank for International Settlements. Are agreements among countries of what are adequate capital levels for the member countries' banks. Now, there have been several rounds of Basel, where they issue new standards of what the capital levels should be. So the latest level or latest round was round 3. So we will focus on Basel III in this lecture. The textbook gives a lot more detail about the history of Basel and the reason for the different rounds. And as always, history is very informative to understand where you are right now, but let's just talk about where we are right now for this lecture. Now, the standards that have been adopted internationally have been adopted by the US through law, and specifically we have the FDIC Improvement Act. This is commonly referred to as FDICIA. Now, the essential idea of capital adequacy is that we can calculate a capital ratio by dividing a bank's capital by risk-adjusted assets. And the risk-adjusted assets denominator is important because different banks can have different levels of risk. You could have one bank that has all of its assets invested in treasury bonds, for example. Well, that's very safe. But that is different than a bank that has invested all of its assets in, let's say, subprime mortgages. That's going to have tremendous more credit risk than the treasury bonds. And so you don't want to compare the two banks by just dividing its capital by its total assets. We want to adjust the assets for the amount of risk the bank takes on. Now, if a bank has a capital ratio or capital level below certain cutoffs prescribed by regulation and law, then there will be consequences on the bank so that they will want to, or be in their interest, to get their capital level to what's considered adequate. Now, everything we're talking about in this lecture and most of capital adequacy standards are credit-based, where we are adjusting assets for credit risk. Now, there are separate add-ons to the capital adequacy that we will calculate during this lecture for other types of risk. There's one for market risk, and if you read chapter 15, you'll see that there's a fair amount dedicated to how capital is calculated to provide a buffer against market risk for banks that have market risk, that have a lot of trading securities. There potentially could be an add-on for interest rate risk, but this hasn't been implemented. But potentially there could be an add-on capital requirement for interest rate risk. There's also operational risk. Now, operational risk you can basically think of as earnings. So a bank clearly needs to be generating profits if it's going to continue to exist and to be able to pay its liability holders. And one that's particularly new, and since the financial crisis of 2008, is systemic risk. And this is the risk where we have to take into account that banks are connected to each other. And if one bank fails or one financial institution becomes insolvent, then that's going to have a ripple effect to other financial institutions. So there could be an add-on capital charge for a bank that's considered particularly systemically important. So that's the overview, but let's get right into how we calculate risk-adjusted assets. This is the major part of calculation of the capital level. Now, the way that assets are weighted is actually more complicated than what I laid out here. So I tried to give a summary of the main types of assets that fall into different categories, just to give you a flavor of how weighting works. The textbook gives more detail than this, but you can see here that the assets that don't get any weight are the ones that are incredibly safe, like cash and treasury securities. And as we go down here, you'll see that there's greater credit risk inherent in these assets, where we have government-sponsored enterprises, basically Fannie Mae and Freddie Mac, local debt, which are called munis. Then we start going into mortgages with higher loan-to-value ratios. LTV stands for loan-to-value ratios. So the higher the loan-to-value ratio, the more risk, because there's less of a likelihood that the collateral will be sufficient to cover the loan, and that the borrower will have an incentive to be current with payments and not lose the house. And then we have business loans, and then we have loans that are past due, junior lien. These are the ones that get paid second after a primary lien, and ultimately securitization exposure. And then there are ways to weight lending in different countries based on the perceived risk of business in different countries. Now we take these weights that we see here. We take these weights and multiply them by the asset values in each of these categories and add them up, and that gives you the risk-weighted assets. So I recommend that you look at the other page to see where I'm getting these from. But if you look at the previous page, these were all items that did have a 0% weighting. And so to get the risk-weighted portion, you add up all of the assets times, in this case, 0%. And of course, that's 0. The next group of assets have a weighting of 20%. So we'll weight that by 0.2 and add up everything in that category. And that will give you 21, a risk-weighted value of 21 million. And so on. So 0.5 times, we're going to add up everything in there. And when you put that into your calculator, you will get 208.5. Then we have commercial loans, consumer loans, and premises equipment. That all has a 100% weighting, so we'll weight that by 1.0. Add all of that up, giving a risk-weighted value of 520. We have loans to countries with a particular rating that has a weight of 1.5. So this would be ones that would be considered having significant credit risk. So the risk weighting is actually greater than the value of the assets. We're going to add up all of these assets times their weights. And that will give us what's called the risk-weighted assets. Which will be $764.5 million. So let me highlight that. This is definitely an important number. Again, this is the risk-weighted assets. All right, now, you may remember from our discussion of Chapter 16, a significant risk that banks have is from their off-balance sheet activities, and that was really hard to, the risk was very hard to measure. If you recall, when we were looking at the off-balance sheet activities schedule. This means that we need to have some assumptions or some rule for how we convert the values we see on the off-balance sheet schedule into what's called credit equivalent amounts. So the amount of credit risk that is, well, it's not so much about the credit risk, but it's what the value would be if this did have to be recognized on the balance sheet and therefore get a risk weighting. Right now, there are two kinds of off-balance sheet items, right? So there's two broad types of off-balance sheet items. The first is guaranteed type and contingent contracts, basically the loan commitments and letters of credit. These were things like the bank has extended a certain amount of credit to its credit card borrowers, but they haven't drawn down all that they could. But the borrowers might, and the banks are obligated to make those loans. So we discussed that. So if you don't recall it, I highly recommend, it's one of the shortest recorded lectures, if not the shortest recorded lecture on off-balance sheet activities. I recommend you look back at that. And there's a percentage that is used to multiply the dollar amount that you would see on the off-balance sheet activities schedule. And you multiply these percentages by the dollar amount on the off-balance sheet activity schedule. All right, so we'll come back in showing how to use these percentages to calculate the credit equivalent amounts for things like letters of credit and loan commitments. Now, the second type of off-balance sheet activity would be derivatives. Now, we've just been talking about derivatives also, but remember, our purpose here is calculating the credit risk, or to offset the credit risk. So we're not worried here about, well, what if the option is out of the money, for example, or if the futures contract will have a negative payoff. We're very narrowly focused here on the exposure to counterparty risk. All right, so this is the risk that the counterparty will default, that they won't honor their end of the agreement. Okay, so the risk if the counterparty to the contract defaults in both the future, that's called the potential exposure. Now, if you have an exchange-traded derivative, like a futures contract, this really isn't a big concern. So there's just a very small percentage that would be multiplied by the what's the margin requirement that is required by the exchange. So we're really not going to be focused, in at least our examples, of exchange-traded derivatives, because again, the counterparty is the exchange, and this is something like the CME group. We're not worried about them defaulting, but we are going to be more concerned about a over-the-counter contract where there's a bilateral trade with another bank, and so that provides a much greater counterparty risk. Now, the way you would calculate this counterparty risk from a bilateral agreement is you multiply the total exposure, and this is basically the notional amount. So remember, the notional amount is what's reported in the off-balance sheet activities schedule, times a conversion factor. And these conversion factors is this table. So you just look up the particular kind of derivative on this table and multiply its notional amount by that conversion factor, which we are about to do. Now that is telling you what's called the potential exposure. Now there's also a current exposure, which is really the risk that the counterparty doesn't honor their commitment today. And so if the counterparty doesn't if a counterparty doesn't honor their commitment, the value of that contract that you've basically lost is the replacement value. So we measure the current exposure by the cost of replacing the contract today if the counterparty defaults, but this cannot be less than 0. So as you might realize, that there are some times when a contract could be in the money, and then it would have a positive payoff, and the replacement cost could be negative, therefore, because basically you'd be the one getting paid if you got that contract replaced. So there's a floor here for the replacement cost at 0. All right, so we add both the potential and the current exposure to get the derivative equivalent amount. Right, and again, the derivative equivalent amount is the other kind of, or the derivatives are the other kind of off-balance sheet activity. The other one were the contingent-based activities like loan commitments and letters of credit. All right, so let's put it all together in this example. So if you missed any of that, hopefully as we go through the example, it will start coming together for you. So I've put all in one place examples 2 and 3 from the textbook, and there are all of these off-balance sheet items for this bank. Now the first section here are the guarantee type commitments, the guarantee type and contingent contracts. And the second type here are the derivatives. And so we need to calculate what the credit equivalent amount is for these off-balance sheet items. So for the, let's write next to it, each line, how we're going to do it. So we see here a 2-year loan commitment. Now we're going to go back up to the information about credit guarantee, guarantee type and contingent contracts, and we see unused portion of loan commitments with original maturity of more than 1 year is 50%. So this was a 2-year loan commitment, so it is greater than 1 year, it's 50%. So we will take $80 million times 0.5, because the weight we looked up on the table was 50%, and that's 40 million. The next item is 10 million direct credit substitute standby letters of credit issued to U.S. corporation. So let's look up standby letters of credit. We're going to go back to the table for these types of contracts, and we see here standby letter of credit 100%. Again, these terms were discussed in the off-balance sheet activities lecture. And then we have $50 million in commercial letters of credit. So let's go look up commercial letters of credit, and we see here there's commercial letters of credit, and that gets a 20% weighting. So 50 times 0.2 is equal to $10 million. So we got 10 million, 10 million, and 40 million. Right now, the derivatives, remember that was a different way of calculating the credit equivalent amount. So we have a fixed floating interest rate swap for 4 years, notional value of 100, replacement cost of 300. Now the notional value is going to be used for calculating the potential value, the potential exposure. So we had an interest rate contract here, and we're going to use the factor for 1 to 5 years because it was a 4-year contract. And notice that these are all in percent, so 0.5%. So let's just do this down here. We have the notional value of 100 million times 0.005, right? So this is the potential exposure. And then we have a replacement cost of $3 million, right? So that's the current exposure. And that will give us $3.5 million for the fixed floating interest rate swap. All right, and just because I'm running out of space, I'm moving everything down here. Now let's talk about the euro-dollar contract of $40 million. Now a euro-dollar contract is just an agreement between banks to lend dollars. The term euro, don't get confused by the term euro-dollar and think this has anything to do with euros. It has to do with international banks, and they make loans to each other in different currencies. And this just means that these international banks are lending to each other dollars, and they can make loans for different maturities and dates in the future. So that would be a credit contract, and I would consider that to be investment grade because it's a euro-dollar contract that's between two banks. And it was a 2-year contract, and so that also would be here in this category. 5% is a credit contract. So we multiply the $40 million times 0.05 because it's 5%, not 0.5%. And the current exposure is 0 because remember what I said, that the replacement cost will have a floor of 0. So 0.5 times 40 is $2 million. All right, so these are the credit equivalent amounts for all 5 of these items that are off-balance sheet items. All right, so the off-balance sheet credit equivalent amount is equal to 40 plus 10 plus 10 plus 3.5 plus 2 equals $63.5 million. Right? Now then the last step, the total is going to be on balance sheet plus off balance sheet. So if we go back to what we did earlier, this has all been the same bank. So when we calculated the risk-adjusted assets, risk-weighted assets, it was set 764.50. The off-balance sheet that we had just calculated was 63.50, giving us a total risk-adjusted assets of $830 million. All right, now what do we do with the risk-weighted assets or risk-adjusted assets? Before we get into it, we need to define some terms. We, remember, will divide capital by the risk-adjusted assets. And there's several different ways to define capital. The most restrictive definition is basically the book value of the common equity. And that's called Common Equity Tier 1. Now the reason for Tier 1 is that there used to be, remember there's a history to the Basel rounds, basically Tiers 1 and 2. There's Tier 1 capital, which is essentially equity. As we see here, it's common equity and preferred stock, right? Equity, at least from an accounting sense. Capital are primarily loan loss reserves and convertible and subordinated debt. So these are equity-like, but not exactly equity. You think about subordinated debt, this is junior to senior debt, and therefore there's a greater chance of it defaulting, so or not getting paid, and so it's more like equity than other bonds. Now, the capital ratios are based on these definitions of capital. So you have the common equity of Tier 1 divided by the risk-adjusted assets, and that's the CE Tier 1 capital ratio. You have the Tier 1 risk-based capital ratio, and that's, as you could imagine, Tier 1 over risk-adjusted assets. And then there's total capital ratio, and that's Tier 1 plus Tier 2 capital. Divided by the risk-adjusted assets. And there's one other ratio, and that is the Tier 1 capital divided by basically risk-adjusted assets. So basically just the total assets plus off-balance sheet assets or contingent assets. Now these ratios all translate to something, and they're important for what's called prompt corrective actions. Category, and this is all unique. This is all and this is a U.S. standards here. So what happens to a bank if they don't have sufficient capital adequacy? And we can see here that there are these different zones from well capitalized down to critically undercapitalized, and there are these essentially arbitrary cutoffs that establish whether a bank is well capitalized or not. Obviously, you do not need to memorize this table or anything. I just want you to understand that the higher the capital ratio, the more adequate the capital is. Now, what does it mean to be in any one of these zones? Well, there's certain consequences. If a bank is well capitalized, and roughly speaking, if we just looked at one of these criteria, all of these would have to hold to be well capitalized, but this is basically saying 8% of Tier 1, 8% of risk-adjusted assets have to be Tier 1 capital or more. And if all the other criteria are met, well capitalized, nothing happens to the bank. If they're merely adequately capitalized, then there's a limit in deposits. They can't accept brokered deposits because those can be taken out pretty easily. If it's classified as undercapitalized, now we can see that there's a lot more restrictions here. They can't pay dividends. There's going to be restrictions on fees that management can collect, and plus everything above. And so as we keep going worse here, all of the above restrictions will be in place, and then in addition to the other things. So basically, punishments to equity and management, basically you don't want them to be taking out cash from the bank when it doesn't have adequate capital. And they have to have some plan in place to have more capital. Now, the focus has been in this chapter and in capital adequacy on credit-based capital adequacy, but there are, as I discussed at the beginning of the lecture, many add-ons to this. So there's the market risk, which was discussed in chapter 15. There's operational risk, which is a function of earnings, basically. That Chapter 20 discusses. And Chapter 20 also talks about some new add-ons, which are buffers or surcharges that were part of Basel III, and largely because of the financial crisis. So one is a capital conservation buffer, which basically says store up capital in good times. And what's really interesting is that if you look at the Fed's guidance during this last 2 months, is they're telling banks, okay, you stored up your extra capital because we've had a good decade since the financial crisis. Now it's time for you to spend that capital because the world really needs you right now. The world needs you to keep lending. There's a counter-cyclical capital buffer. This is applied in high growth, high credit, or high loan growth countries. So it's similar to the idea of a capital conservation buffer. And then there's a surcharge for global systemically important banks. They have to hold more capital because if they fail, they're going to have such a drastic impact on the entire world that they need to just hold more capital just because they're so systemically important. Now, one controversy that usually comes up with community banks is that everything I've discussed so far is what's called the standard model. All right, so that's discussed here. And you might notice it's one size fits all. But there's an alternative way that capital adequacy or required capital can be calculated, and that's what's called the internal ratings-based approach, which applies to the 20 largest banks. And they are allowed to use their own models that's generated from the data they collect on their own business to assign risk weightings to their assets. And it also allows for diversification of credit risks, which the standard model does not. Now, community banks have often complained that these capital requirements on them are stringent, one size fits all, and the larger banks have more latitude in how much capital they have to hold. And I've posted under supplemental readings some of articles pertaining to that, so I think that would be particularly interesting and relevant to this chapter. I highly recommend you check out all the supplemental readings. I've posted probably the most in this one unit than I have in other topics.